Hey everyone, hope you're having a reflective and peaceful Easter holiday. Um, I believe that's been the way it's been for me. I don't mind a break, but at the same time, I wanted to use the time to continue with this series that I've been doing. And if you feel like you want to be doing some studies over this long holiday break, then here's something that you can look into and study as well. So this is volume 4 in the Best Trade Setup series. Today I'm going to be talking about one of the best support and resistance strategies that you can use if you're a support and resistance trader, or if you've ever thought about it, but you never thought about it in this way, then this could be the ideal setup for you. We're going to be talking about the previous day's high and low, which is so in my mind, it can be one of, if not the only support and resistance strategy you need. I say that to say this. The previous day's highs and lows, the previous week's high and low, your opening balance range, your session highs and lows, the initial balance range, all of these levels in price, the round numbers, they can act as support and resistance, basically. Because guess what? You're going to be getting price sensitivity at these areas. And so the whole idea of support and resistance is that in the traditional sense is that we're looking for price to get to a certain level where it would have rejected before, or you'd have had several pushes to that level before, and you're expecting a reaction from that area. In this case, you're not necessarily looking for price to go to that level and would have rejected before, but in this case, you're expecting a reaction from the area. And that's how the whole idea of seeing it as a level of support and or resistance comes in. So let's dive into that. In terms of a definition, it's quite simple. The previous day's high is the highest point of the previous day in terms of the price point, and the previous day's low is where price reached in terms of the lowest price point of the previous day. Now, some facts surrounding the previous day's high and low. These price levels are one of the best, as I said, support and resistance levels you'll find in the market. They're extremely sensitive price levels due to the volume of liquidity resting in these areas. And that is so because what you'll find is that, again, you'll find the breakout traders having set their stops in terms of buy stops or sell stops, or even their stop losses in terms of where they want to exit a trade if they go wrong. We'll find both of these in these levels on a daily basis. People might be carrying trades from the previous day, and they're saying, okay, if price breaks through that level, it's going to continue. That's the breakout trader thinking. And they're thinking, all right, they want to get in and continue the move with the breakout at the high of the day. And you're going to have persons based on their analysis thinking that price is going to reverse based on probably another level on the daily time frame, for example, or 4-hour time frame. They're thinking that when price hits that high of that daily candle, it may reverse. So you're going to have pending orders there, and they may be triggered in by either the spread or the fact that price actually gets there. And of course, we know that there will be some manipulation in these areas. And so the idea is to be able to see the manipulation, allow it to happen, and then we look for entries. There are always going to be stop hunts in these areas. So we'll know how to get around those. The daily high and low can also, as I had said just now, be an initial balance high or low. Well, no, I didn't say this, but at this level, you can also find that you'll see that this same level is the initial balance high or low. So if it was Tuesday's high, for example, which would be the initial balance high and or low, possibly, or Monday, and say Tuesday was the previous day, we're now in Wednesday, it could be that Tuesday would have the price level would have passed Monday's high or low, and then that becomes the initial balance high or low, and then that also becomes the previous day's high or low. So it is in that sense that I speak. And this now would make it an even more stronger and sensitive price level to watch. You can build a strategy and create an edge using this concept alone. And that is a fact. You can simply just look to be trading the daily high or the daily low, the previous day's high or previous day's low. And that alone will give you enough entries for the week for you to be profitable once you have built a profitable model around these levels. In terms of when price gets to these levels, what do you do? What do you anticipate? The setup can also coincide with trigger days. For example, first red day, first green day, inside day, the day count, or the daily cycle. You'll find that these can also coincide with the previous day's high being triggered. So let me elaborate a little bit on that. So for example, if the previous day's high has been triggered and yesterday gave you a first green day signal, a first red day signal, for example, and price gets to that previous day's high, you're anticipating a sell on the first red day and price getting to the previous day's high. It is a stronger confluence for you to say that yes, you can actually look for sells because of the price point at which price has reached, the level at which price has reached, and the signal that you got from the day before. So in combination with that, it's quite powerful, and your setup is more likely to happen as opposed to just maybe just the previous day's high being triggered without even a trigger day along with it. So it just gives you a higher probability trade in this case. Steps to take the trade. So you set your alerts at the previous day's high and or low, depending on if you're a seller or a buyer on the day or looking to do both. Because some persons literally only look for sells because they're more aligned with selling, and some persons only look for buys every day because they're more aligned to buying. So it depends on what type of trader you are. You can either look to sell or buy, and some persons go both ways. You can do the ping pong thing and trade both ways. So it depends on who you are and how you trade. Once that price level is triggered by the alert, you can anticipate two things. You can anticipate, as we've said, price only does three things: breakout, pullback, and reverse, or breakout, pullback, and continue the trend. And it can also break out, pull back, and consolidate or go into a range. But in this case, we're anticipating two things, because what you'll tend to find is that the previous day's high and or low will be triggered during one of the high volatility sessions, such as the London session or the New York session. So you'll tend to find that there will be either a strong continuation or a strong reversal at this point, which is why I'm only including two of the possibilities here. So the following can help you to know what to anticipate. So you understand where in the cycle, the weekly cycle you are in terms of the market, understand what setup day you're in. As I just said, whether it's a first red day, first green day, an inside day, whether you're at the initial balance high or low, whether you're at the previous week's high or low, you're at a monthly high, stuff like that. Understand how many levels of rise or fall price has already made. So sometimes on certain pairs, for example, for currency pairs, price can jump 50 to 75 pips in terms of a pump. And once price gets to that, what you'll call the range in terms of the average range or the daily range, because some pairs move only a certain amount of pips per day. So once you're seeing that price is exceeding that daily average range, then you can tend to look for a reversal as opposed to a continuation. Apologies. So things like that can help you to understand where price is going based on how many levels of rise or fall price has made. In terms of metals, it can be up to 750 pips. It can, in terms of oil commodities, it can be just about the same, 750 pips in terms of looking for the maximum in terms of where price has gone to, in terms of rise or fall. You understand the day count, meaning are you at a day one? Is Monday day one, Tuesday day two, Wednesday day three? Was there a false break at the low of Tuesday, coming out of breaking below or above Monday's high or low, and then closing back inside? That would be a false break. That would have given you day one in the daily cycle, and so that would be day one of the 3-day cycle. Then, so say for example, Tuesday broke Monday's low, but closed back inside of the low of that level, inside of that level. It didn't break out and continue. It broke out and closed back inside of the range of the previous day's low. That would count as a day one. So what you're not expecting, that day two will be a continuation. I'm to do a video on this. You'll understand better the 3-day cycle. And then day three usually can be another false break reversal, which could create another day one, or it could also be another continuation. But day three can be one of two things: a continuation or a new day one. So so things like that in terms of understanding where you are in a day count helps you to understand what price may do when it gets to the level of the previous day's high or low. And of course, we always have to check our news calendar to see what type of events are scheduled. So if we have any major news, that would increase volatility, and we'd know what times to get in. If price is triggered at the same, if the highs or low, or if the high or low is triggered at the time during the news event, then obviously we'll have to wait to see how that plays out before we actually look to enter. So our first bounce trade would have been an ideal thing for the after news event trade. So things like that will guide you in knowing how to enter and when to enter. And of course, we all have our entry criteria that we use. For example, it's a no news day, no major news on the calendar. What do you do to place your entry once? What do you look for in terms of when price gets to the previous day? Is high or low, to know whether you're going to be looking for a continuation trade or you're going to be looking for a reversal trade. We're going to get into that in a little bit. All right, so here are some examples as to what that may look like. So this is US 500, and we see that price was triggered, the daily low was triggered here. This is April 6th, and this is a 15-minute time frame. So I wanted to give you the view from this time frame, and then I'm going to fall to the 1-minute time frame, which is the entry time frame, to show you what that would look like in terms of how I would look for an entry. Right, so this is what it would look like on the 1-minute chart. We see the dump coming all the way up into the 9:30 hour. I believe this would be the 9:30 candle that spike there. We get our W formation, our double bottom pattern. We get price giving us that volatile move, pushing up. I know, as I said, we all have different ways of entering. I've studied ICT. I can see how I could have used an ICT fair value gap to enter here at this point, but because we're talking about Stacy Burke and his ways of looking for entries and so on, then my entry would have been at this, as I've always said, the engulfing candle after the break and the pullback, the engulfment. So this would be the retest, the engulfment, and a decent push to the previous day's high, which would have been this aqua line here. turned into the solid line here. This is a really nice trade, and I mean, it's one of those days where it's the ideal setup, to be honest. You're going from the low of the previous day to the high of the previous days. What more can you want in terms of range? All right, so this is what it would look like broken down on the 1 minute. You're looking for that pattern. You're looking for that shift. You're looking for the retest, and yeah, you're looking for the continuation. In this case, this was a reversal, obviously, so it's a false break reversal at the low of the previous day, and price turned around and went in the other direction. This is one example of the previous day's high being triggered. This candle alone on the 15-minute time frame would have said it all. Price is reversing. Just this alone would have said that. So let's fall off to the 1 minute time frame. Same idea. Looking for the engulfment. So this candle engulfed the bullish candle here. So we had the breakdown of price, brought down past probably about 2 levels there, and we had a pullback, the engulfment, and price continued to the previous day's low. And another beautiful setup. I don't know if all of us would have wanted to sit through all of this chop here, but if you're using a higher time frame bias, then you would know what to expect in terms of where price is going, or anticipate as to where price is going. And so you could have sat confidently through this, knowing that once you get a false break reversal at the previous day's high or previous day's low, those are really strong points, and price tends to reverse rapidly from those areas and move far too in terms of the range. All right, so I wanted to also show you an example of what it would look like in terms of a continuation at the previous day's high or low. So these two are previous day's high examples. We just reverse that in our heads for the previous day's low. It's the same thing. And so during the London session, we had a break at the previous day's high. But what you found is that price went up, came back, retested the same level twice, and then just gave us this sharp break. This was the obvious move that told us, all right, price may not be coming back. Pull back and retested this level, and then just continued off into the rest of the day. The same thing happened here. Break at London, retested a few times, and then just left. And that was it. Price never pulled back and then continued as well. I have a breakdown at the 1 minute chart. So these are different scenarios in terms of entries that could have been taken. And as I said, it depends on the entry model that you use. This is if you're using an ICT fair value gap. So the market structure shift and the pullback, you would have gotten this entry, having seen the retest to the daily high and the shift in market structure. That would be telling you that price is going to continue. And this could have been an entry to continue, or if it is my entry, I'd be waiting for the engulfment here, and I would have just caught this movement in price as a continuation move. Once I would have seen the 3 push pattern here, 1, 2, 3, I know that would have been my signal to exit. And as I said, if we want to be trading both ends of the market, this was quite obvious that this was a reversal. And we'd have to bear in mind that price had already broken out of the previous day's high. So we're not looking for any long moves coming back here. And so would have had to watch this carefully. Another 3 push pattern would have told me that, yes, it's time to get out again. So 1, 2, 3, and that's it, exit. The same thing happened here. You had 1, 2, 3 pushes. Price started to consolidate, then reversed. 1, 2, 3 pushes, consolidation, reversal, and that's how it continued. And then you had 1, 2, kind of hard to count here. But after this, these are outside of the the high probability time windows, and so we expect any and everything to happen outside of these windows here. So you could have gotten buys here, could have gotten sells here, and if you're trading outside of the window, you could have gotten a trade here to take out the New York high. And that would not have been a bad trade. It's just that you'd have had to sit through all of this chop, and it would have taken quite a while. But if you have that patience, then this could have also worked for you. The engulfment, the 3-push pattern, the shift, which tells us that there's a change in direction, the retest, the engulfment, and that could have been another entry as well. So 4 possible entries coming off of that on this day. If we are sitting through all of this time to say look for as many trades as we could have for that day as possible. If we're just looking for a sensible trade for the day, we would have taken one of these. That would have made sense, and just call it a day after that. But that's the entire idea of waiting for price to trigger the previous day's high or low. We wait for either the false break reversal, or we wait for that break and continuation of price. But we have to know what to look for in terms of, is price breaking out and then closing back inside to give us a false break reversal, or is it breaking out, retesting, and continuing to give us that continuation pattern so that we know that price is going to be continuing. I hope this was clear enough. If you have any questions, please let me know. I can always do a follow-up video on this. And I hope this helps you in building your tool, your array of strategies in terms of just sifting through, finding the one that works for you, and helping you to build your edge in terms of your trading. As always, we keep it simple. We stick to the easy money, and we get 1% better every day. Thanks for watching. Again, have a happy Easter and have a great day. Thank you. Bye-bye.